Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have ourselves an action-packed macro week this week. And so there's going to be all kinds of things coming at you here that we'll need to discuss and go over. We're not even going to start with the big pieces that await us in the Fed policy announcement on Wednesday, in the U.S. jobs report on Friday. We are going to look at that which is directly in front of us. We're going to first look at what's going on with the U.S. labor market and how it sets us up for those big releases, and then talk about some international event risk, which, while it's, of course, pertinent to the places from whence it hails, also is a key piece of stage setting for global markets here writ large. So we'll begin as we get started here with a conversation today about the RBA policy announcement, the Eurozone inflation numbers that we have coming up, and of course the U.S. JOLTS job openings number. And we'll start in reverse order. So we'll begin with the JOLTS. We'll talk about how that sets us up for the key U.S. event risk later in the week and where the volatility here might come from, and then talk about Eurozone CPI and the RBA policy announcement in that order, and see if we can get a sense for what those things might do to influence not just their local assets, but international markets more broadly, and of course, U.S. stocks, U.S. yields, the dollar, and so forth. So let's begin with job openings. So the expectation here is that we're going to have a bit of cooling. This is, of course, very important because this is going to be the March job openings number. March, of course, critical because this is the month that we started to have banking crisis in the system. Needless to say, just today, another regional bank here in my hometown of San Francisco has been taken off the board, in this case, taken over by JP Morgan. The story, of course, began with SVB, Silicon Valley Bank, Signature Bank, and that was, of course, March. So how the general sort of U.S. hiring landscape changed in that month will be very important. And the part of this that's really key is how this filters into the part of inflation that isn't the transitory part, the part that ultimately got the Fed thinking, we can't just leave this thing alone. We can't just assume that COVID disruptions in supply chains will mend. That will bring down the costs of doing business. That will bring down inflation. We don't really need to do much of anything here. This is a transitory self-corrective thing. This, what you're seeing on the screen now, is why that was not actually the issue. This is the supply-demand mismatch in the labor market, which of course has been exacerbated tremendously in the wake of COVID. And you can see that by looking at the depth of the blue bars there, the supply-demand balance in the gray and the blue bars. In the gray is when supply outstrips demand. You can, of course, see that's the heart of COVID. That's early 2020. Tons of labor, not much demand because everything is locked down. Then, as you get the recovery, you can see that inflation rises as you get that supply-demand balance worked through. And you arrive at about a 3% inflation rate, give or take, once that has actually been worked off. What happens is then you get a significant move in the opposite direction. So you have a lot more labor demand than there is supply. And so you can see the bars flip negative and become the biggest that we'd seen in years. You can see before COVID, there was already a bit of a labor mismatch, but it was nothing like what we're seeing now. And of course, that comes with the retirement of baby boomers, the largest component of the overall U.S. labor market, and also, of course, the one with the lowest participation rates because they are very rapidly reaching retirement age and exiting the system. What happened here with COVID is that those folks that perhaps were close to retirement within a few years threw in the towel and said, oh, everything is locked down. Okay, I'm leaving. And so we had a much more acute mismatch after COVID than one before it. And that, of course, has contributed to inflation. When you have this kind of a mismatch, how do companies compete to attract scarce labor when there is more demand for labor than there is the supply of it? Well, you compete on price, which in the case of labor means wages. So you get a significant pickup in wages that then feeds inflation. And what we see now is if this JOLTS number, which is of course a huge input in the demand for labor, the number of job openings out there, then the upshot is you would be looking at the narrowest mismatch since about September of 2021. So that would be now the fourth consecutive month that this mismatch has been hemmed in, and would be a good argument in the direction that what the Fed is doing at slowing the economy is having the desired effect. It isn't just squeezing out the kind of inflation that would be squeezed out in general, because the transitory factors that impact it are going away, because what the Fed is doing is restricting economic activity, making things more expensive by making borrowing more costly and slowing economic activity in the process. That the Fed is really starting to have an impact on the larger story, on the more sticky, more difficult to address part of the story. If then the number surprises on the downside, because of course this was SVB March, then that would speak further to the possibility that the Fed can afford to take a pause on rate hikes here, because that which it has done already seems to be working on this more difficult to address part of the inflation story. And if in fact it's working, then there's a credible way to say we get from where we are currently, which is 5% CPI, 4.2% PCE, down to something closer to 2%. And of course, if we look at break-even rates, the markets do think we're just about ready to say the Fed has done enough to get to where it needs to go within about a 2-year period. So expectations here might get reinforced. You can see the likelihood that the Fed is going to raise rates here later this week, at this point, almost 95%, 24, essentially 23.7 basis points of 25 needed for a full hike are already priced in. You can see there is a slight chance, very narrow, that you might get a little bit more in June, but not really significant at all. The probability a mere 23%. You hold steady there through July. You can see that you have essentially 95% of a hike. If you look at the number of hikes cuts column there, 95% of one priced in for May, 123% of one priced in for June. So a slight chance you could get more than one. Come July, it's one. Come September, you're looking at the beginning of cuts. So there is, at that stage, the beginning of perhaps the easing cycle, about a 50-50 chance that we're going to get a cut come September, 73% chance of a cut by November, 78 by December. So you can see there the cut almost fully priced in by December, but of course that's a full cut relative to now, which means that what we'd be talking about there would be a grand total of 50 basis points in cuts, because we would have to undo the hike that we're going to do later this week and then cut one more time to be net one cut relative to where we are today. So if in fact we get a JOLTS number that's relatively soft and this kind of thing is reinforced in that the Fed can credibly say, we don't need to do more immediately, things appear to be working, then you have an interesting question to reckon with. Because there is the possibility, markets of course have been speculating on the end of Fed rate hikes for a long time, there is the possibility that we get a buy the rumor, sell the fact kind of Fed announcement later this week, whereby that they are pausing is taken not as a good thing, but as a sign that the Fed has inflicted enough pain on the economy, both up to this point and in the pipeline to come, because, of course, a big chunk of what the Fed has already done in terms of rate hikes will take many months more yet to absorb, which is how we're at CPI of 5% now, 4.2% PCE, and why the market looks at the two-year break-even inflation rate now and says, well, that's at about 2.1. To get from, let's say, 4.2 PCE to a 2 PCE, which is where the market roughly thinks we're headed, even if there are no more hikes beyond this one, which again, the market is fully baked in already, pretty much, you would have to have more economic pain. That would come with the hikes that have not been absorbed yet coming into the system and fully being realized. And so if the Fed essentially is believed to confirm that this is perhaps the end, and if the JOLTS data reinforces that idea, a question naturally is, does the market still celebrate that? Or does the object of speculation necessarily shift to the consequences? And we can start to see some of that here. We talked a little bit about this last week, but we can see that in the wake of SVB, what we are looking at is very much an evolving relationship between Fed rate hike odds and risk sentiment. So if we look leading in here, we can see that as Fed rate hike odds build in February, stocks decline. This is because we are still in that mindset of more tightening is bad for risk because it increases the hurdle rate on investment. Then, of course, here we have SVB itself, and not surprisingly, Fed rate hike odds collapse, stocks continue to fall, and we develop a direct rather than inverse relationship here. As we continue to move forward, the key thing in this recovery here is that as the Fed policy outlook recovers, with the apparent containment of at least the banking crisis as it's occurred so far, so too you have a rebuild in risk. And now as Fed rate hike odds appear to get stuck and start to dip a bit, so is risk. And what this is suggesting is something very different from what we saw here, which is that if we are in fact in a situation where the easing of Fed policy expectations is being accompanied by stocks going lower, this seems to be consistent with the markets being concerned about recession rather than being concerned about the Fed cooling an otherwise robust environment. Further confirmation comes in the price action that we see in the US dollar. You can see here, as Fed rate hike odds were building, the dollar was rising. Notice that it didn't then roll over until the recovery from SVB started. It actually continued to march higher here and held up rather well through the crisis itself, showing its mettle as a anti-risk haven kind of asset. And of course, that makes sense, especially in a crisis of liquidity, because the dollar is the most liquid thing that there is. And so, not surprisingly, when there was cashing out and capital was looking for safe harbor, it went to where liquidity is most abundant. It went to the dollar. As the crisis started to mend, the dollar weakened. Incidentally, in moving inversely of stocks, which you can see through this period, were going higher. And again, here, perhaps a change of relationship. You can see that as you get a decline in the Fed policy outlook here, the dollar is going higher. Again, showing itself to be an anti-risk instrument, a haven asset, rather than a yields-driven asset. And so you could have a situation here where the Fed comes out, says everything the markets think is generally about right. We are, in fact, going to pause here. We're not going to commit to cuts openly, but hikes for the foreseeable future are on hold as the market anticipates. That may very well be met with a risk-off response, because it would suggest the Fed has judged that there's enough pain. And so with that in mind, you could have this counterintuitive response, and at least counterintuitive relative to what we might be used to over the past year and a half. And the JOLTS data may well be a preview of that. So very important to watch, because it could illustrate the dynamics for the FOMC announcement later in the week, if not necessarily the magnitude of swing. Now, shifting gears to the Eurozone. Here we are looking for April's inflation data. You can see the headline CPI number expected to edge up just a hair from 6.9 to 7%. The core number seen going the other way from 5.7 to 5.6. So a bit of a mixed bag here. Looking at the specifics and the stage setting, you can see that we've already had the German numbers out, and they ticked a little bit lower. The expectation here is that we're going to tick a little bit higher on the region-wide number. Perhaps the German number sets the stage for a bit of a surprise on the downside. We, of course, know that Germany is the largest economy in the region, and so as Germany goes, so too oftentimes we get the region. But it is important to note here that both German and region-wide inflation has tracked with about a 6-month lag the German 10-year break-even rate, which is, of course, the market-based measure of inflation derived by taking the difference between nominal and inflation-adjusted yields. When you take that difference, the magnitude of that inflation adjustment is revealed. And so you can see here that the markets have basically concluded that inflation has already topped in the Eurozone and is now hovering, give or take, near their target longer term, but is at this point slightly on an inclining path, but very gently so. Overall, the picture seemingly set up for stasis, whereby if you get a slightly lower number, maybe you shape expectations for the ECB to follow through at their policy meeting later this week, which of course we'll do a deep dive for on Macro Money later in the week, but perhaps not setting up space for a whole lot of hawkish extrapolation and change in outlook. Indeed, if we look at Eurozone economic data, it has increasingly deteriorated relative to forecasts. And there is some sense that perhaps the ECB is being looked at as more hawkish than they're prepared to actually deliver on. You can see that here. There has been a very pointed shift in the yield curve. You can see the priced-in policy curve now down relative to where it was since the last ECB meeting in mid-March, and of course, even relative to where it was last week. So the weight of that economic data deteriorating relative to forecasts, as we saw here, has been a more dovish outlook. You can see that we're still looking at a meaningful amount further in hiking based on current reckoning. But if regional CPI undershoots, that would be an argument to push this still further lower, reinforcing the idea that global central banks as a whole might be ready to end the inflation fight. You can see here, looking at the priced-in expectations, one hike fully baked in for this week, with the slight possibility of maybe a little bit more, 28 basis points out of 25 baked in. A second hike fully baked in at this point for June. A third hike, though, does not look like it is fully on the board. We're almost there in September. You can see the increase there, 73 basis points relative to now. That's almost the full 75 you need for 3 hikes. That would be the place where it seems like the hawk's hand is weakest. So if whatever comes out here significantly undermines the case for that third cut and gets that 73 basis points that you see in September wound down, and perhaps a quicker move to cutting, you can see that first cut already coming on the boards by February of next year, almost, not quite. We have a situation then where the euro has room to get weaker, yields have room to get weaker overall, although we'll see how much conviction there is ahead of the ECB itself, and of course the Fed, which will precede the ECB. But another very important piece of stage setting for global markets, speaking to growth starting to sour, to risk looking shaky, to stocks looking vulnerable, to the dollar looking like it might be relatively cheap compared to where it could be going if the ECB appeared to be throwing in the towel at the same time that markets are closer to focusing on recession risk and the consequences of all of this tightening rather than the meeting-to-meeting tactics of a given central bank. Speaking of meeting-to-meeting tactics, one central bank that's going to give us an announcement today, early AM Tuesday local time, today for us in the U.S. here, the RBA, the Reserve Bank of Australia, will deliver its policy announcement where it will, according to market expectation, stay on hold at 3.6%. Here's the overall set of expectations here. And again, this is a great barometer of what might be happening globally, how close we might be to some kind of a recession, not just in the U.S., but on an international level. You can see here the speculation is basically that we are fully priced for no change. We flirt with the possibility here and there, but if we look at the implied rate delta column, notice There is nothing here that is even 10 basis points. And so what you're looking at there then is an RBA that is in stasis through the rest of the year. This is tremendously important because Australia, as we've talked about many times here on Macro Money, is a bellwether economy. It's early in the cycle for global growth. It's a commodity exporter primarily. It's an industrial commodity exporter primarily. And so it tends to experience the business cycle relatively early because it is relatively early in the global supply chain. It provides the raw materials that intermediate economies like China assemble into finished and almost finished goods. The finished goods later then are sold primarily in rich world Western economies. And so if we are seeing the RBA throw in the towel here, the implications for what that could mean global growth-wise might be very significant because they might be seeing things that have yet to arrive elsewhere. And indeed, if we take a look at what's going on with inflation expectations here, we can see in Australia, the break-even rate, this is the 5-year break-even rate now, which tends to lead overall CPI by about a quarter, that has already stalled and has been idling for a while, pretty much at the central bank's target. The RBA aims for a 2 to 3% inflation rate, and you can see over a 5-year window, markets think they're going to get there. Overall, CPI seems to have started to head in that direction pretty much about on time, given the lags here. And you can see the very last number here rolling over to 7%. You can see something similar if you look at housing, which is almost a third, a little bit more as a matter of fact, about 33% of the Australian CPI basket. And of course, housing moves very, very slowly. So it is both usually early in this kind of a cycle, but also by a long mile. The lags to overall CPI take a while. So you can see this is a 5-quarter lag from where CPI bottoms to where housing prices bottom back in the end of 2018. You can see housing prices rolled over already going into last year. That's the year-on-year rate of change in the average for houses in Sydney and Melbourne. And then comparable year-on-year CPI lags 5 quarters later and seems to have, again, started to turn right on time, as the lead-in would suggest. So the RBA seems relatively well founded in at least holding things steady for now. You can see something similar in overall economic data. It's been deteriorating for some time and is now, for a few months, tending to underperform relative to baseline forecast. You can see the index there below 0. And even just starting this week, we have worrying data out of China, Australia's largest trading partner. In particular, the manufacturing PMI number there has dipped below the boom-bust line of 50. As we know in the logic of PMIs, above 50 is growth, below 50 is contraction. The further below 50 you go, the faster the contraction. The further above 50 you go, the faster the growth. You can see that in the latest set of Chinese economic data, manufacturing has dropped back into contraction for the first time since the reopening after those zero COVID lockdowns. You can also see that there's been significant downturns in services and, of course, by extension, the overall index. This does not bode well for Australia, not only because China is its largest export market, but because the things it exports to China primarily speak to manufacturing. The key exports there are coal for energy and iron ore for the smelting of steel. So you're looking at a situation here where inflation seems to be rolling over, global demand, and in particular, demand from China appears to be fizzling. And so what this is for the RBA is, of course, a clear reason to consider standing pat. What this is for the global economy is perhaps the start of a global downturn beginning to show its initial signs. Let's not forget that the reopening in China was one of the big narratives whereby everybody thought that everything was going to be okay, even as the Fed tightens. Needless to say, a bit of a letdown here, and a letdown that's been developing for quite a few months here, but that it's now being reported with this clarity in official data out of China is certainly telling. Looking at the overall yield curve for Australia, we can see it's a little bit higher than the last RBA policy meeting, but down relative to last week. So the market is noticing and is moderating its expectations. There's a bit more room here to moderate yet, given where the RBA curve was at the last meeting, so the market got a little bit out there and is now working its way back. If the message from the RBA is we're on hold, nobody's going anywhere fast, and by the way, we see signs that inflation is going to come in because the economic conditions around both the globe and in particular China are starting to turn in an adverse direction, that would be a message for the Fed. That would be a message for the ECB. It would certainly be a message for markets that would take any signs of pause in the inflation fight from either of those central banks as worrying recession signals. It would certainly speak to those worries and might weigh on stocks, might weigh on overall risk taking. And shock of shocks might be beneficial for the US dollar as a liquidity haven again. And that is Macro Money for today. Thanks very much for joining me. We're here on this show Monday through Thursday every week, right after overtime, where I discuss the day's events proceeding with Chris Vecchio, head of Futures and Forex here at Tasty Live. I'm also on with Tom and Tony on Sundays for First Call, and on Fridays with Chris for Futures Power Hour. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much for joining once again, everybody. Good luck out there on an action-packed week. Speak to you tomorrow. Take care.